know that.
Fritz is the guy at the sushi restaurant. Can I have 44 packets of soy sauce, please?
Could I have one more soy sauce? Sir, please finish the 20 I gave you.
Walks out with all his pockets full.
And wipe off the table.
Yeah.
I would like to get pre-approved to buy a home, but I have over $120,000 in student loans. They're all currently deferred due to COVID. Do I have to count them in my debt ratio?
Excellent question. Yeah, we run into that a lot when we have people that are getting pre-approved, primarily for, to be a first-time home buyer. A lot of times for a first-time home buyer, even if they're deferred, they're still going to count towards your debt ratio because the lender looks at it as they might not be deferred,
eventually.
A year from now, 2 years from now. So they want to make sure you still, if your student loans come undeferred, that all of a sudden you can't afford your house payment. So they do factor those in there. So they're either going to use, if they're deferred, that means the credit report's going to show a zero payment on there. But there's a factor for each type of loan, a factor of either 1% or 0.5% of that student loan amount, depending on the type of loan. FHA used to be 1%. They just changed it within the last few months to be at 0.5%, which I think is good. But that it can add up to a lot. If you've got $120,000 at 0.5%, that means they're going to hit you on your debt ratio for a $600 a month payment. So it's like adding a big car payment in there almost. If you still debt ratio with that, then that's fine. You can do that. You can also get a co-signer, sometimes like a parent or family member to help with your debt ratios. Great question. Thanks for texting that in. We're going to take a quick break. We'll be right back.
Hey, it's Sabrina from the News Junkie, and that mortgage guy Don is my best friend. And now back to that mortgage guy Don on Real Radio.
Hey. Welcome back to the Home Loans Radio Show. We are here doing what we do every single weekend morning here on air on Real Radio, talking to you about what, MJ?
Ooh, about mortgages and juice.
About mortgages, and today, juice talk.
That's right.
Yeah, at some point, MJ asked people what their favorite juice was.
And juice.
And
it was because I was talking about breakfast and then crisp short glasses of apple juice.
Yours is not to reason why. Yours is to listen and enjoy it.
That is correct.
So bossy. Welcome back to Home Loans Radio, folks. You can text in your questions to 77031 or just tell us what you're doing out there on this beautiful last weekend in August. What you're gonna do, where you're going, what kind of juice you like.
Yeah, I can picture someone right now driving, listening, going, Home Loans Radio, mortgages, and then they're like shopping and they're like, what juice do I want?
So many choices.
There are a lot of choices.
Ray in Palm Bay says, hello, love the show. Are rates higher for a refi if you take money out? Thanks.
That is a good question. And yeah, the answer is yes. The rates are a little higher, usually about 1/8 of a point or 1/4 point higher, depending on your credit score. The lender looks at it, Fannie Mae, Freddie Mac, whoever, they look at it as though it's a slightly riskier loan. And then it also matters what the loan to value is. Like if you're doing a cash out loan up to the maximum, which is 80% of the appraised value, you're going to pay a higher rate than if you take cash out at 75% or 70. It goes every 5% increments. And then once you get down below 60%, there's not really any adjuster for it. It's just 60 to 65 is a better rate than 75 to 85. So the more risk associated with the loan, the higher the rate. And yeah, cash out will be a little bit higher. So like if you were the best qualified getting a 30-year rate and term loan, you'd probably be like at around 2.875 right now. But if you are doing a cash out, you'd probably be a little higher, maybe 3.125. And that depends on the level of that percentage, that if you're up at 80% or lower on the value. So yeah, good question. But yeah, you can expect that to be a little bit higher when you take cash out. The other thing people don't realize, if you just need a little bit of cash out, you can get up to $2,000 cash out on your regular rate and term loan without it being treated as a cash out. So you can get a couple thousand back if you want to do that when you do your rate and term loan. Rate and term just means you're lowering the rate or possibly the term on your refinance. Thanks for texting that into 77031. You can get your question in. We've got about a half hour left to answer your questions, and a lot of people are. Let's just keep jumping on some.
Yeah, we got a couple some information about the solar panels.
Yeah.
One says that some
Well,
companies.
let me reset. We had a question about whether
Good
solar
boy.
panels add to the value of your home, and then I had a question about when you're redoing your roof, do you have to take all those solar panels off and put them back on,
Right.
and how does that work?
And this question is addressing that issue. Some companies have it written in their agreement that they will take down and reinstall the solar panels if the roof needs to be repaired at no cost to you. You just have to find the right company.
Oh, okay.
But here's someone else who says, FYI, if you do go solar, take note, it will void your roof warranty.
Oh,
Son of a.
They don't tell you that.
that's something.
That's a big deal.
Yeah, I did
and
not know
also,
that.
best juice, lychee.
Lychee?
Lychee. How do you say it, Fred?
Lychee.
Lychee.
Yeah.
Delish. Thanks for your show.
It is.
Lychee juice.
Mm-hmm.
That, you know what, my
It's
favorite.
a strong juice.
Yeah, it's not as
Is it?
popular over here, but in Eastern or Asian markets, it's massive. It's like apple.
Mhm.
So it's like
It's a fruit.
it's like almond milk. I know they call it a milk, but I think
No.
almond milk is a juice.
It's just a squeezing.
Almond juice.
You
They-
squeeze
they
in the
should call
almond.
it an almond squeezing.
It's not. It ain't milk. I can tell you that.
Right?
I think it's juice, almond juice. They're misnaming that. It should be, should be almond juice.
I like squeezing.
Okay, almond squeezins. Mm-mm.
Oh, man. It's like a George Jones song.
Here's a question. Good morning. Should we pay down our credit cards before we apply for a refi? Also, what is the difference between a home equity line of credit and a cash out refi?
Yeah, great question. Thanks for texting in to 77031. It just depends whether you should pay down your credit cards or not. It depends on where your credit score is. Because if your credit score is 740, well, then no, that's not really going to make any difference. If your credit score is 640, then paying off some of your credit cards or paying them down may make a difference. What I encourage people to do if they're in this kind of situation is start the application. Go to homeloansradio.com, do the application. Then we'll look at your credit report. And when I pull up a credit report, it tells me what your score is and what your potential score could be. If you were in if you paid off this or paid off that, it tells me what the score could go up to. And we can also run this tool called a credit simulator, and it will give us an idea of what to pay things off. So it may not even pay them off. Sometimes just paying a card down by $500 will raise your credit score 20 points or so. So we can look at that and kind of target it. I have a client that I'm working with right now that did this exact thing. The rate we would have been able to give them based on their current score was 4.5. We had them pay down about $2,400 in targeted amounts on 5 different cards. And now the rate we're able to get them is 3.125 because we are able to rescore and do a new credit report and then give you the interest rate based on that better score. So the answer to that is I would want to look at it, like actually examine it and not give you a blanket answer. So if I look at it and we can use it to get your rate lower, we can definitely do that. What was the second part of the question, MJ?
Second part is, what is the difference between a home equity line of credit and a cash out refinance?
So cash out refinance is a first mortgage. That means you're going to refinance your first mortgage, but we're going to do the new loan at an amount higher than what you owe on the old loan, maybe $50,000 higher or $38,000 or $100,000. Or I had someone to do a $400,000 cash out recently.
Wow.
They were looking to buy an investment property, so it just depends on that. But so if you're doing that first loan, paying off your existing first loan and getting cash out on top of that, that's a cash out loan. A home equity line of credit is typically going to be, that's not a loan that we do. That's more something you do through your bank, through your corner bank, or where you do your checking and savings. Usually they're for smaller amounts, like in the $20,000 to $70,000 range. And typically they're based on a floating interest rate that's tied to prime, which to me, that's kind of risky right now. Prime's very low right now because of COVID. They've got it down close to zero, but the Fed has already stated that before 2023, they're going to raise that rate 2 or 3 times. And if you have a HELOC now that's tied to prime, every time they raise that prime rate, your HELOC is going to go up. So that means your payment is going to keep going up and your interest rate is going to keep going up. So I'd be certainly careful, if not cautious about, or both, about doing a home equity line of credit. The good thing about them is you can pay them up, you can take out money, pay it back down. So it just kind of sits there almost like as a slush fund. But you can do the same thing with your cash out loan. You can take that cash out and put it in the bank and actually have a real slush fund that you're not paying, that interest that could be floating or moving around on. So thanks for texting that into 77031.
We've had someone weigh in on the lychee pronunciation and says it is lychee. So
How do you know?
Oh, so I'm wrong.
Well, they said.
Well, I mean, when you're reading it, they just put in extra E's?
Yes, they put next to E's. I'm assuming that's what they mean. They didn't give me a whole...
Lychee. I don't think I've ever had that. That's interesting. A juice you've never had.
Well, there you go.
Where do you buy that?
You can just buy it in cans at the Asian store.
At Wawa?
Yeah, just buy a 12-pack of lychee cans.
I bet you can buy it at like Walmart or I bet you can, maybe even at Aldi. I don't know.
I'm going to make it a
Asian
point.
Market, probably.
I'm going to make it a point to try.
Yes. I have an FHA loan at 3.875 rate and a 625 score. Can I get a better deal with VA? I'm a disabled Marine Corps veteran and on a fixed income. My loan amount is $300K and the house is worth about $350. Thank you for your service.
Yes, indeed. Thank you, my fellow veteran. I'm also a veteran, and I think. What did he say the rate was?
They said the rate is. They have a loan at 3.875.
I don't know with your score being at 625 that you're going to be able to get a lot better than that right now, to be frank. But I may, like I was talking to the previous texter, I may be able to look at your credit and we may be able to target a couple things to get that score up a little bit. If you can get it up above 660, then you're starting to talk about rates down in the lower range there. Happy to take a look at it for you. You can always hit me up at homeloansradio.com. You can go to the button there that says apply now. We'll put it together and see what we can do for you.
And the other part was they're asking, could they get a better deal with VA? Generally, obviously they need to work on their credit score, but is that...
It's very possible. They're FHA now. Yeah. So the one thing you're going to be able to do for sure is drop your PMI if you go from an FHA to a VA loan. VA has something, and ordinarily it's called an upfront VA funding fee, which it runs about 3%, or 1.5% to 3%, depending on the type of loan you're doing. But he said he's a disabled military veteran, which would make him exempt from that VA funding fee. So yeah, I think actually I didn't think about that when I first answered the question, but we may be able to, on a $300,000 house, you're probably paying about $250 a month in PMI. So even if I can't get your rate any better, I may be able to get your PMI removed. That's what we need to look at also right away. Yeah, I think you can save some money.
So
yeah, thanks for texting that in.
Go to Home Loans Radio and fill out an application.
Homeloansradio.com. Apply now. Get answers. Get answers today.
I've been working with a lender since April on a refinance. Why is it taking so long?
No.
Jeez.
Oh, you chose the wrong lender. That's why.
Okay. How can they fix it?
I don't know. I mean, there's got to be.
I don't know.
Well, that's a simple answer. I mean, I could say, let us work on it, but I don't know what's wrong. There's got to be something going on there. It can't just be. There aren't lenders that they said this since April. I talked to someone this past week that said they've been working on it since January. Their issue, the people that were working on it since January, had to do with the person having been laid off for a period of time for COVID, and they were waiting for new paychecks at full time to come in. Plus, they also had a cloud on their title, some sort of old title lien for a improvement that was done to the property. So I guess that was what was dragging it. It just depends on what's causing it, really. If you don't know why your refinance is taking that long, that you've been doing it since April, you need to talk to your loan officer. And if they can't give you an answer, then you need to, either get an answer from a supervisor or else move on and take your marbles somewhere else. All
right. I have a quote on a refinance at 3%, but the APR shows 3.873. Can you explain why that is, and why is the APR different? What is APR?
APR is the annual percentage rate. And when you're looking at it on a mortgage, what the APR is designed to tell you is how much you're paying in fees, in closing costs, or in points to buy that rate down. Normally, when I see that, there's a couple big national lenders or big lenders in the area where they like to give you a rate. It'll look so good. It'll be like 2.5% on the rate. And then you look at the APR and it's like, well, it's 3.25 or it's 3.5. Why is that? Well, then the next step is to go to look at the origination box, and you'll see in there that they charged you a fee, 0.5% or 1% or 2%. Which can be a lot. You're talking a $200,000 loan, 2% is $4,000. So you can have a fee in there for $4,000. It'll make your rate look nice and shiny low, but it's artificial. It's that you're paying for it up front. You're essentially that fee is prepaid interest. So you're prepaying, say, that amount of interest, and the APR factors that prepaid interest into the calculation. So in their case, Their true rate is your APR. When you're comparing lenders or comparing loans, you need to look at the APR. You could have one lender that tells you your rate is